positive bias. Bank Nifty is up about 0.1. Small cap index is flat to slightly lower, higher. Nothing very much going on at all. The Nifty heat map gives you a quick sense of how we are stacked up on the Nifty. And then we'll look at individual stocks. Lots of earnings reactions to track. So we'll get down straight to it. On the one end, there is Asian Paints and Indigo. On the other end, there is Hindalco and Grasim. It's about 30 up and 20 down within the first 30 seconds. The market opened 57 odd points in the green, 25,645. Surabhi.
Okay, let's take a look at, Hindalco right away. This is what Nigel was alerting us on. That forget the numbers. More important is the kind of money that they're putting to work. And those estimates have gone up in a big, big way. 5% gone from Hindalco on their capex issues with Novelis. There's Grasim that's also opened lower, 3.5% down. Eternal is down about 1.5%. There's Shriram Finance, which is down about 1%. But now let's see what's bringing up the positive side. Asian Paints, 4% higher. The executive changes at Birla Opus, that seems to be actually working well for Asian Paints. Is the market sensing lesser competitive intensity now? 4% up on that stock. Interglobe Aviation, the market has looked through the bottom line issues. The operational performance was pretty steady, as Sudarshan was telling us, and that's what the market is going with, 2.5% up. M&M is 1.5% higher. Reliance is contributing 1% higher. Sun Pharma after numbers up about 1%. SBI, L&T, Infosys, ITC, TCS, a lot of the big boys all chipping in between 0.5% to about 1%, which means the Nifty is looking at a tidy 50-point gain at the start.
Well, just take a look at these stocks. Hindalco, it's getting smashed down closer around 6% or thereabouts. The street doesn't like, you set out a capex of around $2.5 billion and then it goes to $5 billion in a matter of 3 years. Street doesn't like it at all. Yes, it's going to be a very, very profitable on an EBITDA per ton front. But otherwise, when your cost goes up so much, the pre-tax ROC only comes down to 6%. So why are you doing it? That seems to be the reasoning out there. Stocks, though, that are flying away. Let's focus on a few of them. From the broader markets first, Gujarat Pipavav. Good set of numbers. That stock is up 7.5%. Reddington, we'll have the management will be joining in shortly. That one, in fact, is up close to around 7.5%. RBL Bank, sometimes the streets waits by for some of these large trades to get out of the way, and then it resumes its uptrend. So RBL Bank, after that block trade getting out of the way, which in all probability could very well be the Mahindra Group, it's again, continued its upward trajectory. On the flip side, Ather Energy, stock is down 12%. Volumes are massive. I'm not sure whether or not there was a large trade that took place on Ather Energy. Volumes are very, very large. 10% downtick is what you're seeing on Ather. Utkarsh SFB, that stock is down 7.5%. And Delivery, there was some pre-positioning ahead of its numbers. The street seems to have got it wrong out there because the stock is now down close to around 6.5%. As we speak, big downtick.
Delivery seen a block, but even Ather. So there are some large trades that have happened in the block window on both Ather and on Delivery, which could explain the sudden pressure on some of these counters. We'll see if they stabilize as we go from here. By the way, on the earnings reactions, let's just pull up the good earnings as well. Blue Star, 100 basis points margin expansion. Paytm has done pretty well. Gaurav was telling us contribution margins quite steady. They've been kind of building up. So 3.5% up over here. Apollo Microsystems, Metropolis Health. So some of these results, good results getting rewarded. Allied Blenders, we spoke to the management, still down about 2% on that stock. But yeah, I think the stock of the morning, Nigel, really is Hindalco, still down 6%.
Well, that's right, Surabhi. Those numbers are not very, the numbers were okay, but the street would have digested that. The problem is there was a fire as the Oswego unit in September. The negative impact will flow through in the second half of the year. And yet there's a counter argument that 70 to 80% is insured. So you'll get that money back in FY27. The problem is the capex. It's gone up too high. And that's what will keep the balance sheet, under stress. And that's why the stock is down 5.5%. Remember, it's very, very difficult to time these metal names, right? Because you got the trade right. You're tracking aluminium prices. You were saying that the Midwest premiums have moved up. It'll offset any kind of negative impact of tariffs. And woo, out of nowhere, capex goes up to such a large extent, and that's why the stock is getting knocked back. Let's welcome Anand Shah, CIO PMS in AIF at ICICI Prudential AMC, who joins us on the show. Hi Anand, good morning. Good to see you in as always. What are you making of current market setup? There is a lot of optimism that we get a trade deal, that earnings pick up, and hopefully the market, gives up the recent underperformance. On the contra side, though, the market is still not very, very cheap. How are you feeling about the Indian markets?
Hi, very good morning, Nigel, and thank you for having me. I think, you are right to the extent that one, we are dealing with global growth slowdown. I think the environment out there is as complex as it can get, and global trade obviously has been sort of disrupted. And on top of it, you also have slowdown in some sense in India as well. And I think we have taken some steps in the form of giving a little bit of a monetary stimulus and a little bit of a fiscal stimulus. And again, I'm using the word little bit because that will not take us through, and a lot might be required, but we'll wait for this trade deals. And I think as that uncertainty reduces, maybe the need for further stimulus in India might not be there. So with that background, I think I'm pleasantly surprised with many of the results because many companies have done a good job on bottom-up basis, especially if you see banks and others where they have surprised on the positive side on the results. Many businesses have shown very strong cash flow generation. Again, that tells you that they are conscious of the difficult times, the slowdown that we are in, and have taken some steps to improve cash flows, profits, and to some extent repair the balance sheets.
Okay. Anand, hi. So you sound quite optimistic on the results. So where does that leave us? I mean, the whole premise was that this is going to be a year of earnings recovery, at least 12-13%, if not better. So are we still on track with those expectations?
So I think the story ahead would remain, and I've been saying this for a year now, that will remain more bottom-up than top-down. I think we will have to deal with what we have today, which is lower global growth, impacting to some extent. Inflation is low, so the nominal GDP growth rate is also a challenge. That's below in a single digit in a long time. So all those will weigh down on the broader earnings growth rate. And you have to see that in the context that we had a very strong earnings growth rate for 4 to 5 years. So the base is very high. If you see corporate profit to GDP from the lows of 2.5% is now at 4.7, 4.8%. So I think there's very little room to further squeeze more profit out of the same GDP. So I think what we need is nominal GDP growth rate, which is a combination of a real GDP growth rate as well as inflation. And that remains fairly low, which you might not be complaining so far as long as it's still in the positive zone.
By the way, okay, got that. I just want to go back to Aether because Hormaz is pointing this out. This is really important. So the reason why we've seen some of these large blocks is because the lock-in period has ended for some categories of investors, and therefore we have seen those large blocks worth over 16 crore shares moving around and still down about 9.5% on Aether Energy. Anand, so walk us through last 2-3 months as you've seen this whole GST change and the market tilt its focus towards consumption. Autos have done so well. Walk us through your broad portfolio changes, if any, that you've made.
No, I don't think we've been more bottom up for almost a year now, more than that, and we've been more balanced. So prior to that, we had a lot more overweight in manufacturing allied, as we see recover in India in those segments. We were more overweight corporate banks. Now it's been more broad-based, except that in consumption, we have been more focused on services over goods. So this has been one, and we have upped our sort of exposure to the consumer services businesses while we remain underweight on FMCG and consumer goods in general. So that's been the only incremental change that we have made.
Okay, all right. Anand, if I get sector specific, I think the sector of the morning is paints. The question is, has Asian Paints and Berger Paints seen through the so-called Geo moment? Because the stocks were under pressure. You had a large conglomerate came in there, put in 10,000 crores on the table, said that they're going to be very, very aggressive. They have been fairly aggressive. But these guys have at least held their ground, and it appears, at least some brokerages are indicating, the dent hasn't been that big. Whether growth comes is another question, and valuations, whether or not you're comfortable in it, is another question as well. But what is your view? Asian Paints is one of the top gainers today because the street is now willing to look ahead after the recent price correction.
Sure, I think, look, one of the key element in wealth creation has been consolidation in sector, and we had a very long period of time when you had a limited competition in that segment, paint segment. And generally, if you ask me, in FMCG, in auto, in every areas, India has practically had a duopoly, sort of a 2-3 players in each segment of the market. And that worked out very well for that. And they were a stark outperformers for almost a decade, when actually everything else, particularly in manufacturing, was not doing well. So you had a situation where you had a strong earnings growth rate, peak margins, and the peak PE multiples. Since then, you know what happened in the last 4-5 years in these areas where stocks have been stark underperformers. As the economic recovery happened, the inflation came through as manufacturing picked up. The commodity prices also to some extent picked up. And that led to, but more importantly, what has happened in these areas is new competition. So it's been after a decade of a strong profitability, high ROEs, that you have seen new people coming into that business. Now, having seen the entry of new players with a strong balance sheet, I think there will be a time when there will be still muddling. I don't think we can have a clear recovery in growth and profit. Growth is also a challenge in that context, but nevertheless, if growth comes through, but still the margins will take time to recover as you have now more players in this area than less what we have seen in the previous decade.
Just a bunch of other names as well, right? Indigo is up. Indigo, by the way, is the #1 volume-led gainer. Sud was in the morning talking about how with that large forex loss, was unsure which way to go on this one. So, but it's up and about. Asian, of course, is up. Asian Paints is up 5% nearly now. So the big one as well. Paytm is up 4%. Paytm numbers look pretty good. And there is about 4% gain here. Britannia with the new boss at the top, 4% here, 6,120. Black Buck, which is, I think the Fastag data came out for the monthly numbers, 8% higher on Black Buck. It's up at about 705. It had corrected a little bit recently. And so on and so forth. Shipping Corporation of India is up about 6%. And by the way, on volumes, all of this stuff, right? Not small volumes. Nuvama reported numbers, so solid performance, 2.5% here. Sirma is up about 3.6%. Ixigo had lost about 100 rupees from the highs. Ixigo is coming up about 2.5% this morning. So that's where the gainers are at. And of course, on the downside, we've highlighted Aether with the lock-in ending. Delivery, of course, I think we've highlighted as well. 6% lower. Again, numbers. Stocks done very well, I guess. Remember, with all this stuff, stocks have run up so much across the board that pullbacks are, they seem sharp when looked at against recent performance. NetWeb, for example, right? Look at this one. I think 10% quickly after results, down another 3%, 3.5%. So it had a one-way move, and I think for the year it's still up 30%. Similarly, MTAR Tech is something that I've highlighted after that guidance that they provided here on this channel after the last quarter numbers, and from the highs of 25.70 is down to about 23.50 very quickly, 3 days. Right. So that's the kind of market we find ourselves in. Fair to profit booking as well.
Just one more stock, Infra, we were talking about it on Tuesday, Prashant, and the stock has already seen a big rally. But clearly the street believes that this is a redefining moment for the company on the whole, because after seeing such a big rally, I think it's up 20-25% in a matter of a month or 2 months or so. But clearly now the scale is increasing. And just to tell our viewers, we want further clarity from the management. And in the next 60 minutes, we'll have the management on the show as well. So that profit taking that we saw on Tuesday has got bought into, but clarity is awaited. So we'll get the management in the next 60 minutes on our channel itself.
Yeah. All right. Maybe, I don't know if, Anand, just a quick word, if you will, on and it's right up your alley, right? The capital market businesses. What do you own there, and what part of the capital structure across this do you own, and would you like to get behind or bet on?
I think one of the other, if you broadly see how the consumption is panning out, and I did say about services taking precedence over products in the consumption basket, I think financial services products and services are another thing which have been sort of lapped up by Indian middle class in general, and more and more penetration scope is still there. So I think that's one which is driving growth across the capital markets. I think the financialization of the savings and moving beyond just bank deposits, gold, and real estate, I think we are clearly seeing over the last 2 decades. And it's not yesterday, but for last 2 decades, we are seeing slowly and steadily the savings pool is now going beyond gold, real estate, and bank deposits. So I think the capital market plays in general, depending on whether it's life insurance, asset management, wealth management, broking, and others, are differently but benefited by this one particular theme, which has been ongoing for a while.
Okay. All right, Anand, we'll leave it on that note for this morning. Good to have you in and get that perspective. And we look forward to another conversation soon. You have a good day. With that, just a quick check on the market. Not too much changing, really. The Nifty is up barely 26, 27 points. And the broader market is about at an index level is down by about 0.25%. Just checking some stocks that are on the move, where the volumes are also fairly large. There's Ashok Leyland, there's Manappuram Finance. These stocks are moving on decent volumes. The South Indian Bank, again, where volumes are fairly high, at least for now. So these are some of the major movers and shakers. We'll do one thing. We'll take a quick break, come back on the other side, and we'll keep it with earnings. And lots of numbers have been coming through. We'll touch base with the management of Berger Paints and get their sense on the second half of the year. Welcome back. Let's, as promised, quickly look at Berger Paints numbers. The company did report a soft second quarter, and you could imagine that because we've had extended monsoons, heavy, flooding and rainfall in various parts of the country, and also, of course, competitive intensity. And that's the real question as we start off: is that competitive intensity coming down? Abhijit Roy, Managing Director and CEO at Berger Paints, is with us. Mr. Roy, great to have you in. Hopefully, you had a fantastic festive season. But before we talk about the numbers and the margins and the volumes, which are looking good, actually, you've done, I think, 8% volume growth. Let's talk about the changes in your industry. Now, because of the exit of the top executive at Birla Opus, suddenly the market's getting very excited. Today, Asian Paints shares are up, by the way, 4%. And I think the excitement is because the market is thinking, has this whole competitive pressure in the paint sector, has it finally come to an end? What would you say?
No, I don't think, it is coming to an end, but it is definitely reducing in the intensity that it had earlier, largely because, of the base effect, which is now going to kick in. So they had started from zero and, they were gaining value from the industry, and that was affecting the growth much more. Now going forward, they already have a, pretty strong base. On that, the growth rate that they will generate and the value, therefore, that they will take away, from the industry will be much smaller. So the impact of that competition will reduce, in the third quarter and reduce further in the fourth quarter.
But
unless something dramatic happens, therefore, the growth rate of the industry will get normalized to a large extent.
But, sir, what makes you confident? Because the group still has deep pockets. I mean, sure, there is a management change that's happened and there'll be a new person taking charge. But it's a deep-pocketed group. So what makes you confident? I mean, are you expecting that... I think you've done 1% value growth, for instance. So are you expecting more price hikes ahead now in Q3, Q4? Just describe this reduction in competitive intensity. In what nature will it really show up?
Let me try and explain with some figures. For example, in the quarter 2 of last year, since they had started just about that point of time, they had done about 450 odd crores as per their own analyst meeting, because it's not a published result, so we don't know. But it's around that figure. And this time they said that they have done about 110% odd growth. So we can assume that it's about 950, 960 crore, which is slightly below the first quarter of this year. And that's what they said, that they have done slightly below last year. Now, if you look at next quarter, and they have been doing around these figures, quarter 1 also was like that. Quarter 4 of last year was also similar. Quarter 2 of this year also is similar. So it's around that 900 to 1050 type of
quarterly
level,
run rate,
which they have settled down, right? So now last year in the third quarter, their sale had gone up substantially, to possibly around 800 odd crores, and then in the fourth quarter it had gone up further to about 900 odd crores. So now when they are doing, say, 1000 crores, the net gain for them will be 200 crore, which is the impact on the industry. The earlier impact in quarter 1, for example, there was zero nearly, or 100 odd crores. And they did about, say, 950 or 1,000 crores in the quarter.
Got it. That's the sheer... I got your point, that's just the sheer quantum of business, which was going, suddenly from a zero base, suddenly 800 crores they took away, so it went away from the industry. So that's normalizing. What about...
It was impacting the growth rate. But I'm not saying that their growth is, completely going away, or the CEO change is going to make, something substantially different. Business will carry on as usual. That will happen. But the tapering is also happening because, initially when they were coming in, they were adding a large number of dealers, from zero base, obviously, you will go somewhere, right? And you keep adding. They had done 2 years of homework and then they came in. And so they had a huge list.
That's what I'm coming to, sir. That's what I'm trying to understand, that when it comes to discounting to dealers, margins, dealer margins, which is where, any large incumbent, when they come in, that's where they disrupt. Has all that normalized? And what about pricing now from here?
So, the pricing is, more or less, I don't think they have been, grossly off that chart or something. It's not like, as people have been saying, this is geo moment and all that, but that is not happening. You giving it away free, and then this is, it's a small discount over the leader. Anyway, we compete in the market by giving some discount to the leader as well. So it's not something which is very disruptive as far as we are concerned. So from that perspective, I don't see that, really impacting. They have also indicated that in 3 years they will become profitable. If they have to do that, they cannot, discount, massively from here on.
Okay, all right. I think we have spoken enough about the competition, and as you're saying, it's reducing, competitive intensity. So, Mr. Roy, let's get in a few numbers. By the end of this year, what kind of a growth can you give? First half of the year, you've done close to around 3% in terms of growth, with margins in that 14.5% to 15% vicinity. For the full year, what kind of a number are you looking at? Has demand perked up a little bit after the GST rationalization that we have seen? And what about margins? Let's talk about your business. For the next chat, we'll talk about how the competition is shaping up.
Sure. So in Q3, I think we believe that, we will be in the mid-single digit type of value growth. The volume growth will be near double digit or slightly ahead of double digit. As far as Q4 is concerned, we would be closer to the double digit mark or may cross the double digit as well in terms of value growth. So this is something which we are looking at. So if you have a 50-50, you can understand where we will be at the end of the year. Which is somewhere around the mid-single digit, slightly ahead of that. So that's where the value growth will be. The volume growth will be double digit, I think, most probably. As far as the profit is concerned, there are three levers which are going to kick in, this quarter and going forward again in the next quarter. Typically, the second quarter is the lowest, for the industry in general. This time it was even worse because of the excessive rains that we had. So, the sales came down quite a lot, and as a scale effect, it brought down the EBITDA levels as well. That is going to change in the third quarter. Typically, the base itself is higher compared to the second quarter, and on that we expect some good growth. So therefore, it will have an impact as far as the scale effect is concerned. The second part is typically after the monsoon, the mix tends to improve considerably because in the monsoon period, the exterior emulsion sales goes down. So that's something which is going to improve in the quarter, that is the quarter 3. The third reason is that in the urban areas that we have been investing money. One of the reasons why, somewhat the EBITDA margin came down.
Okay.
Now that is basically, institution projects dependent, slightly in the urban areas, and that got stalled in the rain. It's going to revive in this quarter and the next quarter even more so, and therefore we should see positive result there as well. So all of these three combined, and the other benefit which we are getting now is that the raw material prices have come down a bit. So that should improve the margin a little bit.
Okay, Mr. Roy, always a pleasure hearing your thoughts. Competitive intensity is reducing. I think that's the big takeaway. And you're guiding for better times in the second half of the year. Wish you a good day ahead, a good quarter ahead, and we'll chat up soon. Thanks a lot for joining in.
Thank you.
Let's focus on the next management. Suzlon. Mr. Chalsani, the CEO of Suzlon Group, joins us on the show. Hi, Mr. Chalsani. First of all, congratulations. Last quarter was good, on the profitability, on the margins, on growth as well. Now, you're way ahead of that, 60% odd growth guidance that you were talking about. Give us a fresh, concrete guidance, Mr. Chalsani. Don't, give us at least a band with regard to the revenue growth and the margins as well. Volume, value growth.
Thanks, Nigel, for nice words. The H1 obviously has been pretty good for us. As we said that we gave a guidance of 60% for the year as a whole. At the end of H1, our revenue went up by about 70%, and both EBITDA and profit are doubled. Okay, but however, maybe it is disappointing to you, but I will still maintain that guidance of 60% at the end of the year. We're not revising that guidance at this stage. So therefore, when we talk in May, we will see where we reach. But currently, guidance remains at 60%.
Okay, got that. Mr. Chalsani, good to have you with us here, and nice backdrop behind with those windmills. Just a quick word.
That's what we do, Prashant.
No, we took a very short road trip recently, and there were lots of windmills along the way, and we don't know. It's nice to see. Picturesque. Now, what's the impact of the amended ALMM norms for Suzlon, sir? You're the sole integrated domestic player in many categories. What's the impact? What's the opportunity? Can it mean higher margins? Give us a sense.
Prashant, what it does is of course, the ALMM we discussed last time, which components are supposed to be indexed, what is to get listed before you procure them. But the ministry has followed it up with, releasing an SOP that how do you need to do it. And in addition to that, they also came up with what is called a Renewable Energy Equipment Import Monitoring System, REMS, where, you can import only provided you register there. And also they're going to do as next work is to also monitor from the import to which project it's going. So therefore, there is going to be strict controls in terms of import. Whole idea is to increase the domestic component, encourage the domestic manufacturing. We meet that. I mentioned that earlier. We have no issues on this because we are already at plus 80% domestic component. What it will help us is in terms of creating a level playing field and remove the disadvantage of the cost disadvantage what we have with respect to some of the cheaper imports. So therefore, obviously, it would improve the competitive advantage to us. I don't want to talk about margins because we don't want to unnecessarily increase the margins and increase the end tariff because tariff is most important for sector to grow, but significant competitive advantage for us with the ALM coming in. And in addition to that, Prashant, what it does is that this is going to increase the domestic demand for not just for the OEMs, including for components, sub-components. With that, the costs domestically will come down, and also we start becoming the export hub because of ALM. I think this is what will happen in the next 2 to 3 years.
Any worries with regard to cancellation of tenders, sir? I ask you this because there have been some tenders that have got cancelled by the Ministry of Power in the first half of the year. For your business, do you see it as a risk or no risk whatsoever?
Entire 6.2 gigawatts what we have got, which is about 1/3 of that is through bidding auction. And none of those have this PPA issue because we only signed the contract after the PPAs have been signed. And even in the pipeline of projects what we're discussing, contracts we're discussing, none of them are impacted by this. And also, in my opinion, it is they have not cancelled those PPAs. They've only said that we need to relook at these PPAs, retry what PPAs can be signed. Otherwise, you can cancel. But that's a good step because that will actually release the connectivity, which got blocked because the awards. And then other products will come in and they'll replace that with FDRE. In fact, it's good for us. There'll be more wind requirements in the future tenders.
Yeah, it seems solar came under a bit of heat and wind could be a potential beneficiary. Got that. For the industry on the whole, what about tendering? How much do you expect in FY26 and FY27 as well? The tendering has gradually started moving up.
Yeah, they're very clear. In our discussions with them is now they are going to give the tendering with respect to the grid requirement, grid stability. And all the entire tendering is going to be in terms of RTC and FDRE bids. And the tendering would continue to pick up even today as we speak about more than 11 gigawatts of bids are different stages. Some of them are bids submitted and the reverse auction has to happen. Some of the other bids are to be submitted. I think that would continue. They quite keen, the government, that the tendering activity would continue. But more important for us is the C&S segment, which constitutes more than 50% for us. In fact, that segment now revised the requirement of total RE for 2030 from 78 gigawatts to 100 gigawatts. So there's going to be more demand. And then you're also seeing these data centers coming in, okay? Huge amount of renewable energy, what you need. And even you've seen that latest data center announced in Vizag, they said 80% is what they will meet from renewable energy. I think from that angle, the demand is not an issue. So right today, for the next few years, I see a clear visibility of, one is we have already 18, 24 months order book. But future also, I don't think demand is an issue.
Okay, all right. Mr. Chalsani, we'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC-TV18. So that's the Suzlon numbers and the outlook going forward. Stocks at about just under 60 rupees. Mahindra & Mahindra is the next management of the show. It reported a strong set of second quarter numbers. Auto volume boosted revenues. In fact, my colleague Sudarshan spoke with Mahindra & Mahindra's ED and CEO Rajesh Jejurikar. It began by asking him about the quarter gone by and, of course, their October sales data as well. Listen in.
Recently, you announced sales for the month of October, and those numbers looked very strong. For passenger vehicle SUV growth, you have seen almost 27%. Tractor, the biggest positive was you reported a growth of 13% while expectation was just flat year on year. So what exactly is working for you and how do you see the growth going forward?
Yeah. So Sudarshan, we're delighted with October. It's turned out to be a very good month. Just as a context to the viewers, last year Dussehra, Navratra and Diwali were all in the month of October. This time it's got split between September and October. Which is why the positive October numbers has even more meaning because it's been a split festival this year between September and October. We've seen a very strong demand through the festival periods. Depending on what you look at, retail or April to September or April to October or only festival months. We've been along the lines with the mid to high teens that we had said in the SUV segment. So that's been a very positive factor. Like you said, tractors, we had a billing growth, in the month of September, almost 50%. And then a 13% growth on top of that is a very good sign of the kind of retail momentum we saw through Navratra and Diwali across the country. The first part of your question is around SUVs and what worked for us there. Demand from multiple different sub-segments. So, our EVs have done well. That's added a completely new set of customers into our portfolio, people who were not considering Mahindra earlier. Many of them coming from luxury car segment. The two new introductions that we did, we introduced a Bolero new upgraded version, and we upgraded the Thar 3-door as well. That's, worked for us. The 3XO portfolio, which is a sub 10 lakh, in the sub 10 lakh category, saw, the benefit of GST, and that grew. But our mainstream player brand, Scorpio, which is a very strong part of our portfolio, did exceedingly well. The XUV 700 did well. So, Rock. So, it's, I think, a strong portfolio that's now playing out and giving us the numbers. On the tractor side, both Mahindra and Swaraj, have been strong. And in the first half of this year, our market share collectively was 44%. So, we saw the benefits of product upgrades, channel strengthening, all of that play out as we've got into this festival period.
So just, you were talking about the festive season, sir. This time, apart from the festive boost, so GST cut was announced.
Yes.
And after the announcement, you would have certain expectations from the festive season. Do you think that whatever the expectations were, have you met it, like from the demand side? Do you think that it has been met? And for the entire festive season, if I talk about, what is the growth separately for PV as well as the tractor segment? Entire, like by the end of the festive season, what do you think would be the growth rate?
Yeah, so that's what I was saying. So on the SUV, on the PV side, as you call it, we would expect to have seen mid to high teens growth. On the tractor side, again, strong double-digit growth. So both of these in the festival period have seen strong double-digit growths in retail momentum. Of course, this year is not comparable to previous years because there was some transition issues related to pre-GST starting on 22nd September, customers waiting and watching to see, and get the benefit post 22nd September. So this year had a little bit of abnormality, but overall, when we see it in a totality perspective, it's been a strong double-digit growth.
So where do you see to end FY26 with outlook for both?
Yeah, so for ours, in the SUV portfolio, we're talking here, our growth, we expect to be at mid to high teens, which is what we had said at the beginning of the year. Okay. Tractors, beginning of the year, we had said 5 to 7% growth for the industry. Yeah. We are now increasing that outlook to 10 to 12% for the full year. So tractors, we've changed our outlook because of multiple factors. Good rains, very good reservoir levels, government spending in rural, exports of agri-produce happening, which is bringing cash into the economy, and of course the GST cut.
Now coming to the quarterly numbers.
Yep.
So it was an operational beat. As I talked about in my opening remarks, the biggest positive surprise was the margins. You reported margin of 14.5%, very healthy set of margin. And apart from that revenue growth, like you have seen a growth of almost 21%. Now, what are some of the levers that you can talk about this improvement in the margin? And do you think it's sustainable going forward?
I won't comment on the sustainable going forward because we avoid giving margin guidance. One of the things that we've as an organization, I think we manage well, is doing the right level of trade-off between making sure we don't compromise on the ability to grow our volumes and managing our costs well in a way that we are able to get the benefit of that by way of decent margins. So we've done all the right actions, which is, the model mix, trying to sell higher-end versions. In tractors, for example, we did see customers move up to higher horsepower, 40 to 50 horsepower segment. That improves the margin profile. Even on the auto side, we saw, people moving to higher-end versions and variants, so that improves the margin profile. So I think it's a combination of multiple things, including managing costs, model mix, variant mix, and all of that.
So on the tractor side especially, the volumes were up 32% in this quarter. And there also you have seen a significant expansion in the margin. Yeah. Because in the auto part, there was a minor dip because of GST transition you have talked about. But in the tractor part, from almost 16%, you have seen a jump of almost 400 basis points like almost 400 basis points to 20%. Now, with Rabi crop and everything happening, just on tractor part, do you think it's sustainable?
Yeah, so I want to clarify for the tractor part, the festival getting preponed is a big enabler, right? So, you know, if you go to last year, Q2 did not have any festival. The full festival happened in Q3, which means the Navratra, Dasera, Diwali went into early November, but basically there was no festival in September. This year the festival had started in September, so we got almost the full 9 days of Navratra within September. So that impacted September numbers as well. And hence you get operating leverage out of that compared to last year. So, you know, last year to this year, there is a little bit of seasonality shift, which is enabled this year. And I'm not going to comment on the guidance.
Perfect. So now shifting from margin to market share.
Yeah.
It's a huge gain across the board. In SUV, the market share has gained and it's now 25.7%. Similarly for LCV, less than 3.5 tons, even in the tractor part that you have gained market share. So in SUV, now with so many EVs coming up and you are going to launch a new EV, that XCV9S.
That's right, yeah.
So how do you see the market share overall by the end of FY26, or rather than by the end of FY26, if you can just 1 to 2 year picture, if you can talk about SUV and tractor part?
Yeah, so firstly on the SUV part, our aspiration or our goal is to be revenue market share one. Right. I just want to clarify that as an objective. You know, and the reason we've set that as the goal is because our average price point is almost double that of any of our competitors. You know, our products are selling at much higher price points. The mix is skewing towards the higher versions, and which is why we believe that revenue market share is what we want to measure. So we hope to continue being number one by way of revenue market share without putting out a specific number. In the case of tractors, you know, we are already in a very strong position. And we've gained a 0.5% market share on top of that in the first half of this year. So I wouldn't want to give a guidance of whether in this year we're going to increase anything or not, but even staying at this market share for this year, I think is a very strong outcome.
Regarding some of the upcoming launches that you can talk about.
The exciting part of the launch is the new, what we are calling the big electric SUV, and we are calling it XCV9S.
Yes.
You'll learn more about that over the next few days as we lead into 27 November.
So with an increased focus on electric, what is the current booking, like monthly or quarterly, if you can talk about?
You know, we have avoided sharing booking numbers, Sudarshan. So one of the things that we would want to be focused on, what are we doing? So we are in the region of 4,000 to 5,000 a month, which is what we had set out as our phase one objective. And then, of course, we have a new launch coming up.
Okay, welcome. That's the Mahindra & Mahindra management in conversation with my colleague Sudarshan. You know, we spoke with Suzlon earlier on the renewable side, wind specifically. We've got one more renewable power company with us, Acme Solar Holdings. Revenues have jumped more than 80%. Margins are healthy as well. We're now joined by Nikhil Dhingra, CEO of Acme Solar. I mean, if you just look at the renewable companies in the renewable space and look at earnings growth estimates, and these are estimates, of course, forecasted. I mean, estimates for Acme are right up there in terms of strong growth numbers going forward. Thanks for joining in. As I said, once again, Prashant this side, Nikhil. Just give us a sense of how much merchant power you sold in the second quarter. Give us a state of affairs right now as we stand as well, because, I mean, we get the monthly data. Power demand is low. I mean, you know, there are unseasonal rains, etc. as well. So offtake, I guess, will also be impacted. So give us a sense of the merchant power, how much you sold, what are the rates like, and what is the situation now in the third quarter?
Right. So, Prashant, we are a company which does not sell merchant power. We are in most of our power is contracted through long-term PPAs. So in this quarter, we did not sell any merchant power. All of our power was sold through long-term PPAs, which have a constant tariff. So you are right that the power demand was weak given the monsoons and the rain, and of course the in terms of the cyclical part of this year. But we were not impacted because we had our power is sold. It's a must-run power, as you know. Renewable is a must-run power. So our realizations and revenue were constant tariffs. Of course, the generation varies quarter to quarter in a minor way for solar, as our portfolio is primarily solar and it is contracted in a long-term PPA. So we had a healthy revenue and a healthy EBITDA this quarter. And that is our business model. We are only doing merchant power from, let's say, if we have early commissioning and if we have some scope. Like in the batteries, we are trying to do merchant from Q4 of this year. So that is something we are looking at. So merchant in today's time, the peak power merchant only makes sense. So because there's a difference between the solar tariff and the peak tariff. So that is what we are trying to do from next quarter onwards. We have got our battery capacities coming up of around 1 gigawatt hour next quarter. So we are trying to ramp that up and do merchant on that and not on the normal solar or wind.
Nikhil, what is the average tariff across portfolio? Is there anything coming up for renegotiation or in this quarter or the next quarter? And second, give us a sense of, so 1 gigawatt of storage, which means that much is what you'll be able to supply at merchant rates. Or no? I mean, that's just a battery capacity right now.
Yeah. So in terms of the renegotiation and PPAs, and all of our PPAs have been signed in you can say last 4 or 5 years. So they have a tenure of around 25 years. So none of our PPAs is coming for renegotiation or change. And of course, these are 25 years and these are all with the central government, like SECIs are 70% in our portfolio is SECI. So none of them are up for renegotiation. In terms of the battery 10 gigawatt hour, 1 gigawatt hour of battery installation. So this will be sold as the units. 1 kWh is 1 unit. So basically that much revenue. If I can give you an estimate, let's say if there is a 5 rupee differential realization between the you can say charging and discharging power, then we will make around, you can say, 170 crore of annual sort of revenue out of that. So that's the broad numbers. And in terms
so 170 crore merchant revenues.
Yes.
In FY20 in FY27.
Let's say we install it in January 26, so I'm giving a 12-month number. So whenever it's a 12-month number because 12-month number starting from whenever we commission it.
Okay.
Nikhil, hi. Now on the question of signing fresh PPAs itself, just tell us, whether anything got done in Q2. What is the PPA pipeline looking like? Because there have been a lot of reports that because of slightly lower demand and perhaps overcapacity already in the system here in India, PPA, especially on the renewable side, apparently are also getting cancelled, or the government at least has been sort of withdrawing some tenders. So explain to us what's going on and whether you would be impacted in any way.
Right. So we signed 50 megawatts of PPA with Tata Power. That's our first PPA with the private discom. And of course, we signed 550 megawatt hour with NHPC. So this quarter we had these two signings, and we won around 750 megawatts of solar plus battery tenders. So we had a good run this quarter. Of course, there have been talks about delays in signing of PPAs, and you must have seen the MNRE has also responded to that there is no broad cancellation which is being pursued for these PPAs which have not been signed. Of course, they will review each and every bid in terms of the demand for that. What has happened was there was a lot of, you can say, bunching up of bids which happened in last couple of years. So government has rightly toned down the bid pace now. So very few bids are happening now because the earlier bids are yet to be signed for PPAs. We are seeing that the pickup for firm and dispatchable renewable energy and peak power, bulk of which our capacity is in that segment, is happening. Of course, the pace is lower than the inventory available. So you will see that it will clear over a period of time. But some PPAs which are pure solar or pure wind, which have not been signed for more than 2 years, So that is some, and if there is no demand for them currently, then only government will look at it, whether they need to free up the transmission capacity, because this is more being driven from freeing up the transmission capacities for for letting the you can say more eligible projects come up, rather than cancelling the LOAs, because there is no intent to slow up the renewable growth or renewable capacity expansion.
But as you explained, as you explained that you did end up signing both on the private side with Tata Power and with government agencies like NHPC. So this whole PPA delay business or cancellation business, it's not impacting you in any way, right?
It is not impacting us in any way, and it is not impacting most of the players in any way. What is getting impacted maybe is the slow bid wins, but we also won 750 megawatts of bids in this quarter. So there is enough actually in terms of the bid wins and in terms of the PPA signing. We have already 2.2 gigawatts of signed PPAs with us.
Sure. Just a quick last point on the margins. This quarter, you were at I think about 85%. At the operating level. Just give us a sort of look ahead. Next couple of quarters, can you sustain these kind of levels?
So, Surbi, our EBITDA margins are fairly constant because they are in this range of 85 to 90%. And of course, that is because we don't have any fuel expenses or any such expenses. So this will be the range where we will be for next few quarters. And we have been there for last few quarters as well. So margins will be in this range. Of course, the growth is what drives the key metrics for us. So we have to commission 450 megawatts of capacity this year. We have already commissioned 388 megawatts. We are seeing a lot of upsides from the interest rate reductions. We have been able to achieve AA minus rating for our company. So we are seeing upsides from that, which will lead to margin improvement because of that interest cost
savings.
Interest cost savings, because we are a very capex intensive sector, right?
Absolutely. Absolutely. Got that. Sorry, a little short on time, but we got the gist of it. Nikhil, thank you very much and good luck to you for the rest of the year as well. So the going remains steady at Acme Solar. We have to take a quick break. On the other side, Manisha Gupta joining in with the latest from the commodity markets. Okay, welcome back. And those are the women in blue, triumphant, and they are the world champions meeting the Prime Minister. So some visuals of that meeting coming up over there. That's the winning captain, Harmanpreet Kaur, and she's sporting a new tattoo as well. I think we've got the sound now.
कंट्रोल करती है सबको.
नहीं सर, मतलब वेट था आपसे मिलने का और बस एंजॉय करा और इस चीज़ का वेट था कि आपसे मिलेंगे. बट मेरे को याद है आपने 2017 में मेरे को बोला था कि वही एक प्लेयर है जो उठ के चलना सीखे, उठ के अपने फेलियर से बाहर निकले, बस लगे रहो, मेहनत करते रहो, मेहनत करना मत छोड़ो. तो आपका वो एक वर्ड मुझे मतलब हमेशा मोटिवेट करता है और मैं आपकी स्पीच सुनती रहती हूँ. मतलब जब भी ऐसे टाइम मिलता है तो आप बहुत कूल एंड काम रहते हैं अपने उसमें, जो क्योंकि काफ़ी लोग बहुत कुछ बोलते हैं लेकिन उसमें भी आप इतना कामली चीज़ें हैंडल करते हैं, तो वो मुझे पर्सनली अपने गेम में हेल्प करता है.
आप ये टैटू लगा कहीं घूमती रहती हैं तो हनुमान जी तुम्हें क्या मदद करते हैं?
सर वो भी मतलब उन पे ज़्यादा अपने से खुद से ज़्यादा उन पे बिलीफ रहता है मुझे कि जब भी ऐसा मोड़ आता है कि कठिनाइयाँ आती हैं तो मतलब उनका नाम लेती हूँ तो मुझे लगता है कि वो कठिनाइयों से मैं बाहर आ जाती हूँ. इतना बिलीफ है उनके ऊपर.
और आप तो अपने इंस्टाग्राम अकाउंट पर भी जय श्री राम लिखती हो.
जी, उस पर भी लिखा हुआ है. हाँ जी. जी.
श्रद्धा जीवन में बहुत काम करती है जी. उससे एक फ़ायदा होता है कि भाई हम किसी को सुपुर्द कर दिया, सो जाओ, वो करेगा. लेकिन ये मैदान में आपकी दादागिरी बहुत चलती है, ऐसी जो बात है उसमें कितना दम है?
नहीं सर, ऐसा कुछ नहीं है. एक चीज़ का थोड़ा सा खौफ रहता है, वो मैं बोल सकती हूँ. वो थ्रो का रहता है.
Okay, so discussing their throws and discussing their maneuvers. Deepti Sharma there, geniuses all of them, world champions, meeting the Prime Minister and sharing some much-deserved accolades and, of course, laughs as well. For the timing, it's time to talk commodities. Let's go across to Manisha for the latest. Manisha, what's the big headline?
Well, can't match on what we've done in sense of cricket, but I want to talk about the crude oil prices because we have continued to decline onto this one. It's trading at a 2-week lows right now. We've seen 3 constant months of decline, and this, by the way, is going to be a 3rd straight yearly decline coming for the crude oil prices as well. We're down by nearly 15% for 2025 as we speak. Well, the crude prices in the recent days have seen some support, especially after Russia's Tuapse port suspended fuel exports and refinery operations as well. This is after recent barge of Ukrainian drone attacks on various refining capacities within Russia. So that supply concerns have given some support to markets. But apart from that, there's nothing else which is holding the crude oil prices on the higher side. Because when you look at the US stocks, we are looking at 5 million barrels of a jump in the last 1 week itself. So US crude stocks have been much higher. If you look at the markets in sense of Chinese demand, that also has not been so strong. There's an estimate that in 2026, you could be looking at weaker Chinese demand as the EV segment there continues to grow. There are similar sentiments coming in from Europe as well. The third important point, of course, is the strength in US dollar index. We also have seen probability of almost no rate cut for the month of December. That seems to be bothering various asset classes, including commodities and especially crude oil prices there. And then apart from that, it's not just the US inventories increasing, but the US production has hit a record high in the month of October at 13.64 million barrels per day. So there's enough and more crude. OPEC Plus also has been increasing, has increased to the tune of 2.9 million barrels per day in this current year itself. As far as the overall supply concerns, a supply surplus is expected. That is on the higher side as well. OPEC believes that you could be looking at 1.3 million barrels of a demand growth estimate in the next year. But when you look at IEA, they have a much lower growth estimate of around 0.7 million. So the demand growth for next year isn't so strong, but the supply growth definitely on the higher side. And that is the next number coming in on your screen there. So these are supply excess outlooks coming in from various agencies. Mercuria, which is the largest oil trader in the world, believes that 2 million barrels per day of an excess supply is what you could be looking at in the next year. 4 million barrels per day of an excess supply is what OPEC and World Bank believe into. And CIBC says that 1.5 to 2.5 million barrels per day of an excess supply is what you could be looking at. So anywhere between 2 to 4 million barrels is a consensus coming in there. Now let's talk about the prices. And this year, as I said, it's a third straight year of decline in prices. And next year couldn't be any better as well, is what the belief is. World Bank believes that $68 a barrel is an average price that you could be looking at in next year. CIBC has a lower number at 50, and that really is a headline, really, because 7 Report research says that with the kind of supply increase that we're looking at, there's a possibility that you could be looking at crude oil prices declining all the way to $35 a barrel as well. And that is the most bearish outlook, by the way, till time there. The rest of them really are talking about in 50s and 60s at this point in time. You have Citi at 62, Bank of America 64, and then JP Morgan, Morgan Stanley, anywhere between 58 to 60 as well. So we could be looking at lower averages of what we've done in this year. But well, yes, there are some headline-grabbing numbers coming in too.
Maniju, thank you very much for that. So something to keep an eye out on, and some of those forecasts for especially oil marketing companies, very, very important, of course, on macros as well. Time for a quick commercial break here. It's our segment. It's the economy. Lata in conversation with Macquarie Suresh Ganpati to assess the just ended second quarter earnings of banks and NBFCs. Stay tuned.
Welcome back. Almost all the banking results are out. NBFC results are out. And one key takeaway from the NBFC and banking results is that it was not as bad as the market feared. The expectation of the 100 basis point repo cut on margins was a big fear in the market. But many of the banks, large banks, reported higher margins than in Q1. To analyze the set of results and to check out which are still good buys at current prices, Suresh Ganapathy, the Managing Director and Head of Financial Services Research at Macquarie Capital, joins us. Good morning, Suresh. Thank you very much indeed for joining us. Let me start with the ones who announced numbers last, that is, Paytm and State Bank. First with State Bank, it looked like it was a beat all across, but you're not impressed. I think you still have an underperform on the stock?
Yeah, so look, it was, of course, a pretty good set of numbers. More importantly, as you rightly summarized at the start of this call, that all banks seem to have done much better with respect to margins, and especially on the liability management side, where the cost of funds have, of course, fallen much sharper than expected, and therefore the overall eventual outcome on margins have been way better, and that's what has happened with SBI. The only point here is that SBI had an ROA of about 1.15% odd or so. A large part of it in the first half has got to do with a lot of treasury profits, Lata, which happened in the first half, right? First quarter was bond gains, and this quarter was Yes Bank stake sale. Now, these things are not recurring. So in the sense that you are more like a 1% ROA, and with some kind of an ECL related credit cost coming through your PNL, because currently they don't make really much amount of provisions on SMA 012 assets, you will of course see maybe the ROA is dipping below a percentage point or so in another 12 months' time. That's how we are looking at it, because some of these things are not sustainable.
No, fair point. But there was BOB announcing that there will be a 22 to 25 basis point impact on the credit cost. You think it has colored investor impact on all public sector banks?
I mean, look, see, not all of them have reported the ECL impact, but whoever has reported the rough impact on a transition basis on the net worth is anywhere between 7 to 10%, Lata. So you can go with that kind of a ballpark number. Some banks could be at the lower end of that number. But the sustainable increase in credit costs, because remember that the SMA 1 or 2, the RBI is saying you need to provide 5 percentage points, whereas currently these guys provide only 40 basis points, right? So it's a substantial quantum jump. Now, of course, the SBI management itself is saying that they're representing to the RBI that some of these floor rates recommended are a little bit higher at this point in time. But if I were to literally go by what has been prescribed very clearly, the 20-25 basis points given by BOB is something that will be applicable across the board. So the 20-25 basis points on credit cost is more like a 10-15 basis points on ROA, right? And about 200 basis points impact on ROE. That's something I don't think the market is fully factoring in, which is what I think we need to be really watchful about.
But this 20-25 goes over several years, does it? I didn't understand what Mr. Chand was trying to say.
No, that
is it only in the starting year, or will it be in subsequent years as well?
So there is two impact, Lata, here, right? One is on
the net worth impact. That's different.
That is on the existing portfolio. Okay. Now the other impact comes when you do business in the normal course. In the normal course, you'll always have an SMA 012 assets.
Okay.
There currently are only providing 40 basis points. Now you have to take it up to 500 basis points. So this is 20-25 basis points annual increase, sustainable increase, which will be there for every year as long as you keep doing business.
Fair enough. Yeah. So that's that cost will come. Okay, right. Now Paytm, again, I thought the numbers were quite good, but you have an underperform again, probably because it's already a costly stock. But tell us your thesis.
Yeah, so of course on the valuation side, I mean, some of these new age companies are always going to be a bit tricky to value, and we not even on PB Fintech for that matter, we have a neutral rating. More from a valuation perspective, look, if you look at Paytm's numbers per se, the revenue line item was in line with expectations, right? So where they have done a really good job is on the cost control. They have been able to demonstrate good amount of operating leverage in the business. So maybe they're using AI. They have also, of course, cut their workforce over the course of last 12 to 18 months. So you can clearly see much better outcomes on the operating cost front, and therefore the profitability is improving, and they are generating accounting PAT, which could be sustained as long as they keep a very tight leash on their costs. Yeah, sorry.
Okay. Yeah, I can get absorbed in the HDFC versus ICICI debate, so I'll see if I have time for it. You have some outstanding comments to make on City Union Bank on the bank side and AB Capital on the NBFC side. Tell us why you like City Union Bank so much.
Yeah, look, I think you have to understand that, in today's times when there is a lot of story being spun around about some of these older private sector banks, whether they can generate 1.5% ROA or not, and what could be the path towards it. I won't like to take any of those names, but the expectations are running very high. Here is a bank which is already generating and delivering 1.5% ROA, which is a great outcome. Sustainably over the course of last several years, I would say, except during the COVID years perhaps, and period post that. And also at the same time, growth is back, right? So they have grown their balance sheet, I know, of a small base, but one of the bigger concerns was whether growth can come back for them. So here is a bank which is growing well. ROA profitability is very good, and is trading at a pretty cheap valuation. In the peak, City Union used to trade even at 2x price to book. So that's the kind of opportunity and upside that you still see in the name, which is already delivering that golden 1.5% ROA for the mid-sized ones. As far as AB Capital is concerned, look, I'm pretty much comparing with some of the new age companies, right, or new listings, sorry, for that matter. Look at the HDBs and the Tata Capitals of the world, which are currently listed, and they all trade at 2.5 times forward price to book. Here is a company which is trading at 1.5 times, right? And having an ROA which is similar to them and growth profile which is better than them or maybe equal to them, right? And that's a glaring gap. And that's the reason why it becomes a clear pick for us at this point in time. And numbers have been good so far. Yeah.
Okay. Is that also one of your super six or something like that?
Yes, that's right. So
it's in your up list.
So it's across all the sectors where we identify some of these mid cap guys where there is a longer term potential, and in the NBFC or in the overall, for that matter, in the financial services space, AB cap falls under that.
Okay. If you have to choose between HDFC Bank and ICICI Bank?
Look, I mean, both are good companies, good stocks. Valuations are still reasonable over the longer run. It really depends upon the time frame and the horizon that one has, right, from an investor standpoint, right? So if you're looking at the next 6 to 12 months, clearly you're going to see HDFC Bank getting its mojo back when it comes to its growth, and will be the sector leader in terms of its growth, in my opinion. And that is the reason why, as the growth convergence happen, one can argue that HDFC Bank can converge to ICICI. And the second thing, as we all know, that Mr. Bakshi is slated to retire on October 2026. And there are uncertainties surrounding his tenure. Typically, stocks don't perform that well whenever there is a CEO-related uncertainty. For all that you know, he could get another 3-year extension and things should be fine. But currently, we're going through in that uncertain phase, which is what we need to be a bit careful about.
Well, actually, his term ends and he's very much eligible, way below the retirement age. So I am still not believing this rumor. It was only a rumor which ICICI has scotched in no uncertain terms. So we will leave it at that. Let's see what happens in 2026. Just finally, Suresh, would you say in your overall, I mean, this is a head of research question. Where does finance figure in the bouquet of sectors that Macquarie recommends? Is it up there?
Yeah, pretty much. See, if you look at it in this way, Lata, we always start the year with a 15-16% broader market earnings growth, and eventually, unfortunately, the earnings keep getting cut for the overall market. But even if I were to really look at next year, maybe the overall market can grow potential to 12, 13, 14%. But financials, very clearly, there is a visibility of a 20% earnings growth. So it will outperform the broader market by a good amount of margin. That is only because the first half base this year has been very tough. You've gone through a margin compression. You have gone through, though banks have done a better job relative to expectations, but still YOY the margins have gone down for SBI, for everybody else in the system, right? And you've also seen credit costs being elevated in certain cases, like for Kotak and Axis. If you look at next year first half and of course probably second half, you are going to see margins being relatively positive. That means in an upward movement, credit costs being down. And loan growth should be about 15-16% or 14-15% for the private. So clearly you're looking at a 20% kind of an earnings growth for the broader financial space, outperforming the broader market.
Fair point. So while the rest of the market may grow at probably 13% earnings growth, banks could report 20%. That's the big takeaway from Suresh Ganapathy. And very importantly, old private sector banks, the story is turning. This is a story for another day. First it was Federal, then now RBL, now CSB turned City Union. That's a story to be narrated on another day. Thank you very much, Suresh, for joining us. We have to wrap up on Bazaar. Short purchase coming.